Welcome, everyone. Thank you for joining us for our Q3 2026 financial markets and portfolio update. Today's session will be led by Steve Galley, our Chief Investment Officer and Wealth Management Advisor, who will share insights on current market activity and trends that we're watching. We encourage you to submit your questions throughout the session using the Q&A feature in your Zoom toolbar, and we'll address as many questions as we can at the end of the discussion. And with that, I know we've got a lot to cover, so I will turn it over to Steve.
Thank you, Anna. And as you know, I used to thank Katie. Katie has moved on to bigger and better things, and we wish Katie well. We will miss her. And Anna is now heading up our marketing efforts, and she is going to be a more than capable replacement. So, welcome, everyone. I hope everyone has been having a nice summer. As always, we are going to hopefully make this interesting and fun and inject a little humor along the way. And we always appreciate your feedback because we want to make these presentations as pertinent to you as possible. So as always, we'll be covering kind of what's going on in the market, looking at a lot of those headlines. You can't really talk about the market without talking about artificial intelligence or AI. We're almost all the way through the second quarter earnings season, so we will touch base on that. And it's not always just about stocks. We'll be touching base about bonds. And then, of course, we always like to present sort of a summary of, what the bulls out there are saying and what the bears out there are saying. And then we'll have time at the end for any Q&A. So a lot of the headlines have been focused on how powerful the earnings of companies, not just this quarter, but in past quarters, have been. And as usual, a lot of the earnings highlights are about AI-related companies. And it just seems to be no shortage. And it's not just here in the US, but also internationally. And it's not just public companies, but it's also private companies. I did mention last time that there is some headlines about stress in the private credit market, which continues to grow in size. So that is a bit of a concern. So we'll talk about that. But one of the things that people have been talking about is what's known as the Jevons paradox. So first of all, what's the Jevons paradox? Well, the Jevons paradox comes from a 19th century economist by the name of William Stanley Jevons. And he observed that, and at the time he was looking at the phenomenon of coal burning steam engines. And he observed that the more efficient that coal burning steam engines became, it led to more coal consumption, not less. So basically, what he came up with was that when a resource is used more efficiently, demand for it actually rises rather than falls because the efficiency gain lowers the cost of using that resource. And it can also unlock new use cases for that resource. And so what we're looking at on the screen is another example of a more modern example of that, of when the first Excel spreadsheets came out. And I don't know if many of you use Excel. I know I use it on almost a daily basis. But the fear back then was that, oh my gosh, that's going to put, accountants and bookkeepers out of business because of this new awesome spreadsheet technology. And actually, quite the opposite happened. Accounting and bookkeeping services employment actually increased over time since the launch of Excel. And so this is actually being quoted and used in the context of AI today, meaning that while everyone is afraid that AI is going to eliminate jobs and potentially there's a fear that as IT and all these models get more efficient, the spending on semiconductors, chips, data centers, that will slow down as these things get more efficient, and that will hurt future earnings because of all the spending that's going on. But again, the Jevons paradox is a counter argument to that. Says actually no, as AI gets more cheap, it gets more efficient and cheaper, it's going to lower the cost, which will actually expand its use, which will expand new applications of it, which will ultimately increase the usage and then drive earnings further. So That's why people have been talking about Jevons paradox, and certainly history has shown that that can certainly play out that way. So I think that's pretty interesting. This actually is a nice chart that shows what's been going on with the S&P 500 index over the last 30 years, right? And so uh, I think that when you look at the current bull market, which you can argue started at in mid-October of 2022, because that was when we sort of emerged from the pandemic in full, we really have been on a tear since then. As a matter of fact, the S&P has gained over 116% in total since this bottom in October of 2022. And that gain has eclipsed the average gain of about 114% seen during the last 26 quote unquote bull markets. So going all the way back to 1928, we've had 27 bull markets. This one's total return is higher than the average bull market. So it's really been a nice run. And as a matter of fact, there was a market high in June, but if you went away for the summer, nothing really happened until again August. The rally started again, and we hit a new all-time high in early August. Now, it's been all about earnings. So this has been an earnings-driven bull market, meaning in some cases, there can be multiple expansion and other things that contribute to a bull market. But in this case, it really has been, and we always talk about when you buy stocks, you're buying the future earnings potential of those companies. And it really has been that earnings growth that has driven the euphoria over stocks. And so one reason, and this chart on the right, these gray lines show the last two recessions that we've seen, the first after the housing bubble burst, and then the other mini recession we had, which was very quick as a result of the pandemic. But what you'll notice is during recessions, earnings of companies tend to drop like a stone. And of course, that is why people sort of obsess over, do we have to worry about a recession? Because if there is a recession, that's going to decimate the future earnings growth of companies, which then will, of course, impact the market overall, which is one reason why a lot of people pay attention to, what economists have to say about whether we may be looking at a recession in the near future. But to that point, at the beginning of the year, there were a few red flags in terms of what we consider to be recession indicators. But as of the middle of this year, there really aren't any. So the bottom line is we really aren't worried about a recession, which means that a lot of this bullishness about company earnings really has a lot of room to run. Since the only thing I think that could really derail a lot of that earnings growth is if the economy tipped into recession, which of course no one seems to be thinking about right now. Now, one thing that has been happening is that long-term bonds, and this is a graph showing the path, or I should say the yield, represented by percentage here on the left column of the 30-year Treasury bond going back since 2005. And again, the gray bars are when there was a recession. And right now, we are at yields that we haven't seen in 20 years. So yields are now attractive. And so the question is, why are these long-term US Treasury bond rates so high? Well, it's really three main reasons. One is inflation, right? We still have somewhat of an inflation problem in this country. Two, well, our budget deficit in terms of the health of our fiscal situation in this country is slowly getting worse. And three, there has been a ton of bond issuance, not just by the government, but also by the big tech hyperscalers who are funding the AI infrastructure build out. So a lot of supply has been pushed into the bond market. And if there isn't enough demand for that supply, that will also cause rates to rise. So the bottom line is we're not going to go back anytime soon to like the levels we saw in the last, decade or so. It looks like the good news is that high rates are here pretty much to stay, which is also great for people who like to clip, their coupons when they own bonds because the rates are more attractive today. And you can see actually even this year, the lighter blue line shows where Treasury rates were at the start of the year and where they are as of last week. And there has been a big jump across the curve. It doesn't matter whether you invested in short-term bonds or long-term bonds, rates have come up across the board. Now, with bonds, when rates rise, prices decline. So what that means is that bond prices have come down, but for those who are investing in bonds today, it does mean that you are getting a nicer yield that you can hold on to for the length of that maturity. Now, this chart actually shows the impact of inflation on bond yields. So the gray line is what's known as the real Treasury, 10-year Treasury yield. And by real yield, it means what is the yield on the bond minus the rate of inflation. And so it wasn't too long ago that we were actually in negative territory in terms of real yields. And I think there's a typo here. This should actually say August 3, 2022. But the point is that you don't really stay in negative real yield territory for long. Why would you why would you invest in a bond if after inflation you're really getting nothing? So we are now comfortably back in the positive in terms of real yields. And again, as long as inflation doesn't get worse from here, that means that even after inflation, when you're investing in bonds, you're earning a reasonably positive return. So that's important. There's been a lot of talk about inflation. And so some of the biggest money managers that we follow and read their research are basically saying that they don't think inflation will be much of a problem moving forward. And so I think while this chart is pretty busy, it's kind of interesting to look at, and this is from BlackRock, showing going back to 1959 that we've had some different inflation regimes, right? And so in up through the mid 60s, we had low and stable inflation. And then we had a big inflation problem in this country starting in the mid 60s and going all the way to the late 70s. And that's when Paul Volcker had to famously break inflation's back by raising interest rates, which then caused a big recession. We had a disinflationary period in the great 80s and going into the mid 90s. And then we had inflation that just stayed at or below 2% for a long time, all the way from the mid 90s all the way to 2019. Then, of course, the pandemic hit. We had this unbelievable spike in inflation. But now, the common wisdom is we are entering into a period of more normalized inflation. So the long-term trend should be in our favor. And research that we were looking at from Goldman Sachs, they were pointing out that a lot of the things that are causing inflation to remain a little high today are probably what are they call one-off effects that we should discount moving forward. So some of the big research houses really think that inflation should not be a problem moving forward. I certainly hope they're right. The market, of course, doesn't seem to care very much about inflation at all or be worried about it because, as I highlighted here, the column, this shows what the various market segments have done year to date. And I think it's interesting to notice that on a year-to-date basis, the Russell 1000 Value Index, as opposed to the Russell 1000 Growth, has been on a tear. So the nice thing about what does that mean? It means that the market rally that we've been experiencing this year has broadened out to companies beyond tech-oriented growth stocks, right? As a matter of fact, one of the reasons that the Russell 1000 Growth is so much less of a year-to-date gain than the value index is because software companies are a big component of the Russell 1000 Growth Index. And software companies, many of them have been decimated this year because of fears that AI is going to put them out of business. So that's been an interesting dynamic within the indices themselves. The nice thing to see is the Russell 2000, which is small cap stocks, very strong. Emerging markets, which is, Brazil, uh, Taiwan, Vietnam, other countries like that have been on a tear because they have been building a lot of the AI infrastructure parts that have been feeding the AI frenzy. And we've talked about that before. So, the only thing that's really negative this year are bonds. And we just talked about why that is. But that still doesn't mean that bonds don't have an important place in portfolios. It's just that with rising rates, bond prices tend to decline. And so the reason that the return for bonds this year is essentially flat is because even though the yield that bonds are giving is positive and in a good range, the rise in rates have offset the benefits of that yield in terms of the price decline, right? So, but I think for the rest of the year, we should see bonds ideally eke out a pretty decent gain, since I think most of the rate rises are behind us. So then the inevitable question is the stock market expensive? Well, this actually shows the stock market what it was a year ago. And remember, these dotted lines, the middle dotted line is basically the 30-year average forward price to earnings measure of the S&P 500, which has sat around 17x, meaning you have to pay 17 times every dollar of earnings that a company makes in order to buy that company. We were in pretty uncomfortable territory about a year ago at this time when we were well over 22. And remember, the last time we saw that, well, it happened a little bit briefly post the pandemic rally, but then it also happened right before the dot-com bubble burst. So you really don't want to be outside these dotted lines because that just means that you're in rare air, right? That's pretty rare. Now, if you're down way below here, if you have the ability to buy when others are fearful, as Warren Buffett would say, that would have been a good move, right? Because inevitably you will usually get back into this area. But where are we today? Well, we are back into this area, right? And that is because the earnings growth has been so strong. So even though the market has gone up, the forward price to earnings ratio has gone down because the earnings have been so strong, it has actually lowered that ratio. And that should give us some comfort that now stocks are not in what I would call an extreme valuation territory. So because earnings have been so excellent, that puts us into a zone that at least we're more comfortable with where things are priced. Now, this is a pretty busy slide, but the bottom line is this is telling us what the earnings have been over the last several quarters in terms of positive or negative surprises. And it's pretty amazing if you look over the last several quarters, positive earnings announcements from companies have pretty much averaged close to two-thirds of the time, meaning two-thirds of the companies who report earnings actually surprise to the upside. And that can be pretty hard because the analysts who cover these companies usually are fairly optimistic. So the fact that companies have been surprising to the upside is again indicative of why we've had such a strong market because companies' earnings have delivered. So, the key thing is that going to continue to happen? And quite frankly, the analysts are saying, yes, they do expect that to happen, at least for the next year or so. Now, it's not all about bullishness. I think this is a pretty interesting slide produced by our friends at Apollo, which shows the profit margins of the overall S&P index, which is the blue line, the S&P 493, which is the S&P less the Mag 7, and then the top line is the Mag 7. So the point of this is that profit margins for the Mag 7 have been really growing, and that's been great. It hasn't really broadened out to some of the other companies in the S&P 500. So in other words, the spend that companies are making on AI is not really showing up in profit margins across the board. So hopefully this will actually start to broaden out a little more. But, it's important because the longer it takes the S&P 493 to generate, return on their investments, the bigger the downside risks are to those stocks and the economy in general, right? And we've talked about how it is a little disconcerting about how concentrated uh, some of the AI play has been. Now, this I think is a good argument as to why we should be fairly comforted about what businesses are dealing with in terms of their inventory. So this chart shows us the average outstanding inventory as measured by days on a quarterly basis by companies in the S&P 500. And the gray bars represent recession. So as you can see, when recessions hit, inventories tend to drop to fairly low levels. But we are at actually businesses right now are not sitting on much inventory. As a matter of fact, the second quarter of this year marked the fifth consecutive quarter of declining inventories. So companies are running pretty lean. And actually, a lot of strategists that we follow think that has to reverse. And if that reverses and companies start building back up their inventories, that's going to be a pretty nice thing, a boost for our economy. And that should mean that the economy should continue to expand as these inventories are built back up because companies can't stay this lean forever. And another positive sign here, companies have actually been spending a lot, on CapEx, which historically is a positive indicator. So on the left-hand chart here, the ratio of companies' CapEx to sales has risen unusually quickly. And as a matter of fact, the year-over-year growth in CapEx to sales has reached the top decile now. It's basically hasn't been there consistently since back in the 60s. And so what that tells us is that when you're in the top decile of a CapEx to sales ratio and growth, that's been associated with good odds of a market advance over the next 12 months. So this is telling us over here that when you're in that area where CapEx to sales growth is strong, the market usually follows with good results. So I think that should be pretty encouraging. Now, part of our job is to try and understand all that data that's flying around out there. What should we pay most attention to? So that's what we tend to try and highlight here. But the thing to keep in mind is that it's never going to be a smooth ride. So I think it's interesting to look, and this goes back to 1980. The gray bars show us the actual return of the S&P 500 in every year since 1980. So here we are on a year-to-date basis. The S&P, give or take, is up about 11%, or as of yesterday, was I think more like 13 or 14. But don't forget, we actually almost had a 10% correction this year. Last year, 2025, where the S&P returned 16%, great year. But people forget that actually at one point last year, the S&P was down by 19%. So I think the point here is that on average, in any given year, you can actually experience at least a 14% drop. So we have to be a little more comfortable understanding that volatility is really the norm and it's not rare. So it's no surprise that, we have seen already a drop this year. Hopefully that will be the only drop that we see this year. And that hopefully we will again end this year in double-digit returns if things stay the way they are today. So don't be afraid of volatility. It's really just the norm as we can see here. So that's an important point. And then, of course, the other question we get is, well, goodness, if the market is at such great levels and it kind of bouncing around at all-time highs, which it really is right now, should I not invest in stocks right now? And the short answer to that is you should invest because waiting does not pay off. And a lot of studies have been done on this. And at the end of the day, this is really what these charts are showing is that investing at a new all-time high in most cases is actually better than not investing when markets are at all-time highs. So that's just because all-time highs tend to get new all-time highs. And also, if you do stay on the sidelines, one of the hardest things to do is to know when to go in. So the general counsel here, in terms of what to do, is to be in the market, right? And as the old saying goes, it's not timing the market, it's time in the market. The other thing to point out is, and I think this is a fascinating chart, uh, the three bars represent if you are in an all stock portfolio, an all bond portfolio, or a 60-40 mix, 60% stocks, 40% bonds. So the point here is that in any 1 year time frame, and this goes back all the way to 1950, meaning if you invested at the worst possible moment in the stock market over the last 70 plus years, it's possible over that year you could have lost more than a third of your money. It's also possible that you could have made a 50+% return. So the point here is that even in bonds, anything can happen in 1 year. But if you expand that lens out to a 5 year rolling average, even if you invested in all stocks and invested at the worst possible time, the worst that would happen on average over 5 years on an annualized basis is a 2% loss. But if you were diversified in a 60-40 portfolio, even if you invested at the worst possible stock market moment, you still would be positive after 5 years. And then, of course, that continues to broaden out as you get to longer periods of time. And I think the point here is that that is why, uh, as advisors, we always preach diversification, because when you are diversified, it smooths out the ride and also ensures that even if you happen to invest in a very bad market cycle moment, you will be okay in the long term. So I do think it's always important, and that's why we do want to encourage diversification because it kind of smooths out the ride because no one likes to see stomach churning dips in their portfolio. So just to recap quickly about, kind of what's going on out there in terms of the bulls and fighting with the bears. Well, the bulls have a pretty good argument right now because earnings results have been great, and that has justified the rich valuations of a lot of those stocks, right? And they're also saying that guess what? We think those earnings are going to continue. The economy looks great. The consumer, at least the upper echelon consumer, looks pretty strong. No recession in sight. So what are we worried about? Inflation, as we were talking about, looks like it's receding and going to get back to sort of that lower normalized rate. And of course, it's all about AI. AI. Productivity gains from AI are going to be great, and that's going to keep fueling things moving forward. Now, the bears, of course, are saying things are a little too concentrated in tech. It's been all about tech. That can't continue. The earnings growth has been too strong. Inevitably, that will have to get back to lower levels because normally you only get that types of earnings growth when you're coming out of a recession. Well, we're getting that earnings growth and we haven't just come out of a recession. So they're saying that's unsustainable. They cite private credit hiccups here and there as being a little bit of a concern. There's all the geopolitically uncertainty out there. And they're also saying, hey, guess what? I can actually invest in bonds right now and get a pretty good return without taking much risk. So if I can get good returns from bonds, why should I be taking all that risk in equities if I can get, pretty decent returns on bonds and take a lot less risk? So in other words, there are attractive alternatives to equities because back when interest rates were close to zero, there was no alternative, but there is now. As always, bulls and bears have a pretty good argument. So what does that mean that we're going to do and what we're thinking about? Well, as mentioned last time, we did want to be defensive, right? And that was when we thought things were pretty expensive in the stock market. So we are maintaining that defensive profile. We will be adding a little bit to alternative exposure. And what does that mean? Well, alternatives tend to be things that are not correlated to stocks or bonds, right? The point is if stocks zig, you want the alternative to zag, which can smooth out the volatility of a portfolio. So alternatives can include things like futures, commodities, um, uh, real estate, and private market investments that aren't necessarily correlated to the overall public equity market. So we do think that's important to add to portfolios because alternatives have been proven over time to dampen the volatility of portfolios without detracting much from returns. We do like bonds now. I mean, yields today are more attractive than they've been in a long time. So we are slightly overweighting sort of that mid-range maturity in the bond world. We are going to still maintain our underweight on the U.S. large cap sector, just because that's where stocks are most expensive. They are more reasonably priced on the small and mid cap zone. And that's one of the reasons why small caps have done so well this year is because people have started shifting a lot of their allocation to the areas of the market that are more reasonably priced, hence the small cap rally. International has been pulling its weight, so we're keeping our neutral stance on international. And then we did raise the cash position a little bit last quarter, but now we're going to put that cash back to work in things that can do a lot better than cash over time, which in this case would be bonds. So that's what we're looking at in the portfolios. And of course, we can also always have more detailed conversations with clients, and we stand ready to do that. And we always appreciate your trust and confidence in us. So with that, I will open it up to Q&A, Anna.
All right. Great. Thank you so much, Steve. If anyone has any questions, please submit them now in the Q&A box. And it looks like we do have a couple for you. This is a good one. If inflation is supposedly going down and is not an issue, why does everything still seem so expensive?
Right. Yes. I experience that every time I go out to dinner. I will say that the tricky thing about inflation is that all the inflation numbers that you see in the headlines and the press and what the Fed talks about is really measuring the rate of change of inflation, right? And so the fact that we had a serious inflation problem as a result of the pandemic, well, that's not can never be undone. The price increases that we saw in the past, they stay where they are. So it's really about making sure that the rate of those increases is lower today, right? And so the inflation number is really focused on the rate of change. So even though people talk about inflation being lower and hopefully continuing to get lower, that doesn't mean the high prices of the past are going to come down. It just means that they're not going to keep going up as much as they've had over the last few years. So that, unfortunately, is the reality that we live in today. But the hope is that at least moving forward, those price gains will be a lot slower. So that's always a good question.
All right. And then one last one. What do you think is the biggest risk to future stock prices?
Um, that's a great question. So I think if I could sum it up in maybe one of the biggest risks that I think is floating out there, and I think it revolves around a lot of this AI euphoria. So I think the real risk out there emerges if the AI euphoria reverses and the markets become more worried about the fact that all this spend on AI will not result in expected future earnings. And also, I think that this is not just about stocks. It could also be that if the market, which the bond market has been a little concerned about this already, starts worrying about our increasing government deficits. So that could be the real risk is that if the markets turn sour on future earnings potential because the AI euphoria unwinds, and then the bond market is also pretty nervous because it seems like our deficits remain a problem and maybe inflation remains a problem, then there's no hiding, right? Because then stocks and bonds could both be impacted negatively, and that would leave investors really with nowhere to hide. So to me, that would be sort of the nightmare scenario if that were to play out. And I'm not saying that will, but certainly to answer that question, I would cite that as probably the biggest risk if I could sum it up that way.
All right. Well, I think that's a great place for us to wrap up. Thank you everyone so much for your questions and thank you for joining us today. If you have more questions or if you have feedback for us, please don't hesitate to reach out directly. And we appreciate you joining us today and we hope to see you again next quarter.
Thank you, Anna, and thank you everyone for listening. And until next time.